I'd like Dan Rodgers to come and take over. We are having the bank panel. Thank you, Dan. So, he's looking for you. He's your, Mr. Fang. Please, come. Yes, Mr. Fang, here is Dan. Hey, how are you? Good. Please. Thank you. Sure. How are you? Hansen. So Dan, you have the countdown clock there.
Yeah, I know where we're going. Yeah, you bet. Well, good morning, everyone. My name is Dan Rodgers. I'm a partner with Watson, Farley, and Williams here in New York. I principally engage in financing of ships, usually on the lender's side, but sometimes also on the owner's side. We do traditional shipping and offshore from our office in New York. And today I'm pleased to be the moderator for this panel of distinguished shipping and offshore finance people. Immediately to my left is Amit Wynalda, who is the head of Shipping Americas at ABN AMRO. Next to him is Fang Xiuzhi, who is the head of Shipping Finance at BOCOM Leasing out of China. Then we have Shreyas Chipalkatty, who is the head of EMEA Shipping and Logistics at Citi. Finally, we have Ivar Hansen from DNB, and we also have Martijn van Tuijl over at DVB. So we'd like to make the most of our time today, and so without further ado, I'm going to sort of get into our discussion. I think where we want to start is on a broad basis today, gentlemen, and I think the simple question is, what deals are getting done in the banking market right now? And we'll turn to leasing as an adjunct to that. Amit, why don't you take us through what you're seeing on your end?
Sure. Yeah, you know, compared to the beginning of the year, I think we were, when we sat here last March, we're a bit looking outside in the market and seeing many banks not being out there, which was all of a sudden, I think, when basically April started, somebody turned on the switch, and it seemed like that many banks are actually back in. All over the banks that we were afraid were actually exiting the markets altogether came back in. So we see, the usual deals are still being done out there, anywhere between 50 to 60% leverage on all sorts of subsectors, actually. We do see a trend where there's need, we do see a trend, moving away from non-recourse deals, right? So that's, I think, slowly going to be, the past, and in the future there needs to be some form of guarantee, also with changing the regulations from Basel. So that's definitely something that's changing the landscape.
Thank you. I'm going to go down on the banking side, then we'll come back for the leasing alternative. But Shreyas, what do you see from your perspective at Citi?
So for Citi, I think there's one caveat here. We look at all of logistics together, and shipping is a subset of that, and there are subsectors within that. So I think it's important when we talk about what kind of deals, I'm also including in this things like terminals. I'm including floating LNG, I'm floating infrastructure of various kinds. And those are the deals that are getting done. So where you have a clear cash flow story, where you have real relevance to the way infrastructure needs to develop in the world today, and there are people coming in with proper equity, there are good, strong partners, those deals get done. If it is questionable, small, and dodgy, then it won't get done. I mean, that's simply good banking. So from a very broad perspective, as you said, Dan, when you look at logistics, i.e. moving things from A to B, whatever is good cash flow, not so much on security. Security is a good to have from our perspective, but good cash flow, good counterparties, that's really the key.
Thank you. Ivar, do you also at DNB focus on cash flow more than asset value these days?
think cash flow has always been the primary driver of any credit decision when it comes to, deciding both on targets and also, quite frankly, how much capital you want to commit to certain transactions. I mean, this industry will always have an element of this LTV, MVC, collateral coverage. You can name it any way you want, but at the end of the day, banks will look at some form of collateral at least when they look at commodity-based shipping, if you will, tankers, products, dry bulk, etc. So again, to Amit's point, I think this year started slow, but it really ramped up in terms of activity, in terms of the few companies out there that can do deals. What I see is that there's a lot of focus on a few lenders that are still maintaining, active portfolios and continue to lend at, very favorable pricing to certain key companies, and sort of focusing on that niche of the market, if you will. Maybe more interesting is maybe something that you don't necessarily see too much of these days, which is maybe something we can talk about as well. But the largest syndicated transactions have been fewer and further apart. There's been much more sort of small, whether it's club or bilateral transactions that I've seen. Maybe with the exception of some of the logistics transactions that Shreyas and Citi has been very successful with. Obviously, bigger transactions need larger syndicated deals.
Martijn, where does DVB position itself in this market?
Yeah, DVB always has had its own little DNA. We traditionally keep close to the asset. Of course, counterparty recourse are important, but I think we're one of the few, if not the last one, that is comfortable still looking at non-recourse. Even in the spot market, of course, we'll tune our leverage towards making those cash flows work and take a risk that is still acceptable. But typically those are deals that still get done. So moderate leverage, liquid asset, non-speculative for existing clients or for new clients, but serious ship owners. PE back doesn't matter as long as there's a non-speculative element. We're good to go.
Great. Let's take a look at the flip side of this, and let's talk a little bit about leasing. What sort of deals does BOCOM focus on? Is there any particular favored sector that is particularly appealing to BOCOM leasing?
Okay, for BOCOM leasing, especially in this year, we are focused on some LNG deals because we think the market formally is at the bottom. Now we see the chance to have a good market for LNG sector. In other words, we can say it's in clean, green energy sector. So this year we are focused on some LNG deals. Actually, we do some good LNG deals for the LNG modern ships with very low leverage. So leasing company normally do provide product different from bank with higher leverage. But this year we have some good opportunity for LNG ship and with not too high leverage.
Do you see any pressure coming from other leasing products such as Japanese leasing?
How to say, Japanese leasing is always very competitive in terms of cost, especially for the considering the cost level. They are always competitive with us, frankly speaking. But Chinese leasing company in the past, maybe we can say past 5 years, do have achieved some, do made some good deals, not for the reason of the cost, but for the highest, very high leverage, and also has a good opportunity to enter into the market when the market is the newbuilding price or the second-hand vessels price is at very very low. So we think there are some reasons even the cost is not too favorable for Chinese leasing company, frankly speaking. Yeah.
Okay. Well, let's talk about what types of deals don't get done these days. And I guess, why don't you continue from the leasing perspective? What types of deals you would not be interested in doing?
I don't know for other leasing company what they will do or will not, but for Bocom Leasing, that is very clear. When the market, how to say, if the balance seemed not in good order, the demand is, or the supply is more than the demand, will be very careful to enter into that market. That's the reason in the past 2 or 3 years, actually, we have not made many dry bulk ships, especially from 2012 and to 14 or 15. We are focused on container ships. And in 2016, actually, we are interested in tankers. And we have not encouraged, how to say, we have not invested too much in dry bulk in the past few years. Yeah.
Okay.
And also for VLCC, considering the crude oil's oil pollution liability, so we are also not interested in VLCC deals. Yeah.
Understood. Well, let's see what the banking view is. How is it at ABN? Is there any sectors that you're less favorable on than others?
Well, I have to say, and I think I've said it in March also, we are open for all subsectors. We just tailor the deal to where the sector is currently in the market, right? So it needs to fit certain criteria. We're looking at LTV, we're looking at earning capacity, and then we structure the deal to the underlying subsector. And I think that's actually the most important. So, you know, if it wouldn't fit any of that, right? If the request for the certain type of leverage is, let's say, high in the LTVs, right, where you cannot sustain in a certain level, then that deal is not going to be done by ABN AMRO, right? So, especially if you look at, you know, spot employment, you know, if spot employment above 55% or, you know, 60% leverage, I think that's difficult for us as a bank. The other thing, and I don't want to get ahead of some of the questions that are coming, but we definitely stay away from speculative new building financing.
That's interesting. What about Citi? What do you feel about new building financing? How does that strike you?
Well, it depends on how it's structured. I mean, we wouldn't really want to go, and sort of to paraphrase what Ivar said earlier, the question is it the best use of our capital? And if it isn't, we wouldn't do it. Usually the answer is for regular, high-flow, well-regarded clients, we would do those financing simply because there is a story behind why we would do it. Is there a capital markets takeout? Is there an export credit agency wrap that makes it interesting? Is there a big enough bank group that makes syndication interesting, and maybe you are the sole book runner, there's a fee there? It all depends on capital and the returns that the transaction actually generates for that capital. So I don't think that there are particularly any great desires within my organization to fund new fleets, given where we are on most of our supply-demand metrics, notwithstanding all the tiny bumps that we saw in Adrian's presentation earlier. There is certainly a lot of cleaning up to do. We will see what happens with the scrubber and sulfur regime, but given where we are, it depends really on the client, I guess, is the very, very short answer.
Well, I think that raises an interesting question about clients. Are you open for new clients? Ivar, would you like to field on that?
Sure. I think, first of all, we were always interested in looking at new opportunities and new business. You know, but the big caveat is really what Shreyas was so very well put, if you will, the best use of capital, and also the velocity of how you can use that capital. For some clients and certain industries and segments, it's more interesting, maybe because of consolidation opportunities or you know, other things that we feel can create business opportunities going forward. Raising capital, capital markets takeout, bond issuances, equity raises, you name it. Again, you know, again, paraphrasing Shreyas, the big picture is what drives the business decisions. And if a new client or new company or new, you investor, be it private equity or private, you name it, we will be there to look at it and consider it and always be there to try to provide the best possible service we can provide to the client, again, considering the overall business perspective.
Great. Martijn, what about a DVB? Are there any sectors that are more difficult for the bank to consider? And also, how do you feel about any new clientele at this time?
Asset is important for us, so we would stick to the more liquid markets. I think offshore we're completely out of in terms of new lending. I don't think that cruise or ferries is something we would go back into. So we stick to mainstream. In terms of assets, the type of deals we do, we need liquidity, and that's what we look for. In terms of new clients, we've always been open to new clients, be it well-established shipping companies that want us as a bank, or be it a PE that wants to enter on some sort of basis, and obviously we'll give them a deal structure that fits that particular profile, but not dogmatic at all towards new clients. To the contrary.
So at DVB, there really wouldn't be an emphasis on clients that have intentions on going public, for example?
No. That's nice. I mean, obviously, but we do very well with smaller owners. That we're not a big bank ourselves, so we appreciate that. And if we can add value for a growing company that has a good business going for them, why not? That's helping.
Let me switch over to Citi to get sort of a big bank view on this. Do you feel that company going public is a good factor, something that is a plus in your analysis?
Well, I know what my investment banking colleagues want me to say on this one, and obviously the answer is yes, go public. It's amazing. The reality is that dealing with a lot of private families in shipping, it's clear that there are many benefits to remaining private, which are not at all evident to people who don't deal with them on a regular basis. So simply having the freedom, operational freedom, to do what you think is right, and it can go both ways, because we've seen what's happened in some sectors where he bought a ship, so I must buy a ship sort of mentality. But I think there is a lot happening within some of the larger clients across all sectors. Actually, there is a big generational change coming. And within that generational change is embedded the desire to have better corporate governance. Sometimes the next generation doesn't want to be in the shipping game. So there are lots of things which are going to drive the public-private decision within that family dinner table. From a bank perspective, we seem to basically just give the best advice. Obviously, that's what we want. Equity private holding and public holding is one thing, but I think for very good reasons, which we can discuss in the next question if you want, Dan, but I think for very good reasons, diversifying into the public debt markets is something that shipping sorely needs. We are seeing a significant reduction in available bank capital. I mean, this has been a theme for the last perhaps 6-7 years now and across all these conferences. But when you have a well-developed capital markets strategy, it does drive a lot of the sort of corporate governance basics that will be needed when the company eventually goes public on the private side, on the equity side. That fact, I think, is not probably the most important thing when a family thinks about going public, but having that discipline around high-yield markets or investment-grade markets. There are very few investment-grade companies in shipping, but there are a couple. And having that discipline certainly helps with how you're going to look at hiring maybe a CEO or a CFO that's coming from outside, and the discipline that surrounds that. So I think there are arguments both ways. But to answer your question, I think being public confers obviously some flexibility around equity and sharing of that risk. However, staying private, especially in today's environment, where within liner, for example, you are seeing consolidation which allows you to perhaps position for hate the word oligopoly, but there is a logistics set that is developing around these liner companies that includes terminals, includes land logistics. It's a very interesting time to be private because you can do a lot more things and you don't have to explain to anyone what your thinking is and people questioning you. So stay private until you can't afford to anymore, I guess.
That's good advice. Amit, what do you think is the path forward for companies? Should they be diversifying their financial tools? Should they be going public? Or as Shreyas just suggested, stay private until they really need to go public? How do you see that?
I think to a large extent I agree with my colleague at Citi. You know, one of the issues is, just to discuss a little bit the flip side, if you're a listed entity and your market is doing well, you're earning a lot of cash, your investors would want you to invest more, which actually, you know, as being correlated, you're going to be potentially buying assets at a too expensive price, right?
That's right.
Instead of, you know, trying to beef up liquidity and weather for the storm to come, right? Which is, it is a cyclical business at the end of the day. But, you know, I do agree that if you get a certain size of company and you're listed and you can also diversify potentially maybe even, you know, within your subsector or to different subsectors and be large enough and indeed play also the debt capital markets as well, then it can make a lot of sense. But so far, you know, we haven't seen that many companies being able to do that. I haven't seen a lot of shipping companies going to the debt capital markets as of yet. I think the other interesting potentially diversification of funding will potentially be, you know, the private placement of debt. So not so much the public debt, but maybe trying to get debt placed with insurance companies, pension funds, and the likes, right? So that may be an interesting angle too.
Thank you. Tor Ivar, since you run DNB markets, obviously I would think that you would be keen on some of the more public debt or even, you know, private placements of debt that we've just discussed. What do you think is the right way forward for shipping companies in this area?
I certainly see the merits of both being private and being public, and again, I think the focus of DNB markets over the past few years have been very much towards helping companies as soon as they get public, both on the equity side and the public debt side. But again, it really depends at the end of the day on the strategy of the owner, if you will. I mean, it was mentioned here, family ownership. Obviously, that's been a huge part of shipping, and still is a huge part of shipping on a day-to-day basis. And I really see the merits of being a private owner as long as you, again, work diligently towards diversifying your sources of capital, which traditionally has only been the bank market. You know, the private placement market is definitely a market that industry should consider more and more. One of the big hurdles in that market, obviously, is that the insurance companies in the U.S. at least have some very strict requirements regarding their capital allocation towards riskier assets. Basically, meaning that I think 97% of all they invest in has to be investment grade, i.e. BBB minus and above. And as Shreyas put it, there's not that many investment grade shipping companies out there. Now, I think there is some room for improvement here in the shipping industry, considering sort of the third-party rating conundrum, if you will. Do I get rated, and if so, do I do it publicly or do I do it on a private basis? And I think there are very much some good arguments for going private on the private letter rating side, whether it's on a project basis. If you have a 10, 15, 12, 8, 9-year charter to an investment grade counterparty, you can easily monetize the contract on that asset and get very favorable financing in the private placement market. But there also are some structural corporate considerations that I think companies should do, both private companies as well as public companies that don't necessarily want to go to the public bond market for whatever reason. Anyways, I do see the merits of both, and again, we are very happy to help companies, whether it's private placement debt or public debt.
Thank you. Fang, Xiuzhi, is it easier to work in a leasing structure with publicly listed companies who have a more broad-based sources of capital behind them? Does that help in the bank's analysis as to whether to do the deal?
No, I don't think so. Because for leasing company, we look for the when we provide a higher leverage product to our clients, we are mainly focused on the asset value. When the asset value is at the bottom, and in the meantime, the market for that type of ship is good, then we can do the high leverage, and we don't care the public a lot. You know, sometimes the public companies still be very small one.
Right, okay. You know, let's talk, switching it over a little bit, let's talk about private equity and its role in the market. I don't know how this plays in the leasing context. Obviously, private equity companies can come in and own ships in conjunction with traditional ship owners as an equity play. They are also providers of debt capital. Do you see private equity involved in the transactions you're working on at BOCOM?
So far, not too much private equity being involved in our structure. You know, our product is different from the bank. The leverage is already high. So normally we just, as I just said, we just see the asset value, the cash flow, and especially for the client's reputation and so on. So so far, not too much for the equity, private equity being involved. Yeah.
Thank you. Martijn, what's the view at DVB? Do you see private equity continuing to play a significant role in shipping finance?
Yeah. First of all, a lot is in already.
So they have trouble getting out, is that your point?
Whether they like it or not, they're there to play. That being said, I mean, there's still private equity players that take a hard look at the space, and they I mean, of course, they're smarter than the guy that went in front of them. So yeah, there's demand, and we'll entertain, sure.
Oh, that's good. Well, Shreyas, what's your view on private equity? Do you see them fading away or hanging around? How do you view it at Citi?
Well, they are some of our biggest clients, so we would only wish them well. They play a very, very important role, actually. I think as I said before, we need more sources of debt. We need more sources of equity. We need people to take risks around new things that are emerging. For example, automation, digitization. I would love to see private equity come into automated warehouses and floating LNG and technologies around that, which actually might be out of reach for some of the smaller or more risk-averse logistics families. They're absolutely welcome, and actually they are playing a part in these technologies. So debt, equity, please bring it on. And we have excellent partnerships with good operating companies that can lay the groundwork for a bigger strategy. So very valuable partners.
So you would see it principally as an enhancement to cash flow again? Is that really where this is falling into place, or do you see it as something else?
I think from the operating company in which they would invest, I think that's not really much of an enhancement of cash flow, because they should really rely on what that business model is. But I think their connectivity across different parts of logistics, across automation, across new investments, across venture capital, that stuff is really, really important for us to be able to connect better with. And I'm very excited, actually, by what they can bring to the table. For too long, we've been in this sort of asset financing kind of mode around shipping. I think we need to look at what the future is, what digitization is going to make new opportunities arise for us around drones, around data gathering, around artificial intelligence. We are simply not doing enough. So for that kind of discipline, for that kind of connectivity, I think private equity and their own digitization sort of funds, small funds and small strategic teams, those are very useful.
Okay, let's, because we're running a little bit low on time, let's talk about M&A a little bit and the bank's roles in that. Amit, would you like to discuss anything on that front? Do you feel there's enough bank capacity to facilitate such transactions?
Yeah, I mean, I think it is. I think that it makes a lot of sense for some of the companies to go, combine forces. I think that usually they're financed on both sides, and banks are willing to support that. I think that's also on the advisory side. There are banks out there that can definitely make a difference and make the deal happen on the financial advisory side. You know, it's not always there's not always the need to just go through let's say the S&P broker. Sometimes it just makes sense to do things, you know, off market and really discuss it between two owners separately, which I think adds a lot of value. You know, doing that through the banks that support you. So that, yeah, that's definitely our strategy and the way we work with our clients. Absolutely, and we will support those M&A deals. Yeah.
Thank you, Tor. Ivar, what's your view on that?
It's a great question. I'm wondering if Amit is correct, because I'm not sure. If you look at the big shipping companies and the amount of debt they have, there's going to be a question among some banks about the concentration risk once you start consolidating. Now, I hear the point on both sides being banks, and you know, they team up and they sort of take a piece of a better chunk, if you will. But you know, the reality is that in M&A transactions, unless it's really like defensive and for some miraculous reason you find two people who just agree about everything, it's usually done in connection with some form of an acquirer paying something as a premium of the acquiree, right? So it's event-driven transactions of very large sizes. You know, I'm talking billions. You know, maybe it's again hard to say a nominal figure, but I would say that very big bank-driven M&A transactions, I'm questioning whether they can be done purely on the back of banks. I would say that there would maybe need to be some form of both equity raise and maybe some form of public debt to sort of cushion the blow, if you will. I mean, we're looking at fairly big transactions these days in the not necessarily shipping market, but more sort of contract-driven offshore logistics market. And you know, we're talking $1.2, $1.4 billion transactions, and I think the consensus amongst the banks is that even that amount, again, backed by very strong contracts, is just too much for 10, 15 banks to hold on a 10, 15-year basis. So it's just the conversation turns very quickly into how can we term some of these things, some of this debt out in the capital markets.
Well, Shreyas, what's the view from Citi on that, since I know you guys are involved in a lot of M&A work?
No, I mean, Ivar is, I mean, it's hit the nail on the head. All transactions that we've been involved with have had distinct capital markets strategies right after the bank financing was not even dry, really. And that is really the only way to do it. I mean, we've seen what CMA NOL, Hapag-USC, and Hamburg Süd, AP Moller. I mean, all of these are going to be evidently capital markets risk shared. So totally agree with that. I think from an M&A perspective, the financing angle itself is pretty much really standard. I mean, you have an element of step-up pricing to encourage the client to go to the capital markets. But other than that, it's not really that different from how we would approach a normal large syndication. And of course, the partnership with the investment banking community internally and externally, that is the extra sort of element to it. But from a 1 billion or 5 billion perspective, I think it's the same amount of work.
All right, well, we're out of time, and I want to thank our panelists today for providing such cogent insights into the current state of the banking and lease financing markets. And should you have any questions, I'm sure you can approach them over coffee or at any point during the day. Thank you very much for your time.